Hello everyone, welcome back to our channel, where we break down the world of investing into simple, easy-to-understand pieces. Today, let's dive into consumer staples stocks, an often overlooked but absolutely essential part of any well-rounded investment toolkit. So, what exactly are consumer staples? These are the everyday items you buy, use, and replace, no matter what's happening in the world or with the economy. Think about things like toothpaste and toilet paper, products you simply can't do without. Add to that soap, bread, milk, canned goods, and other basic foods that fill your pantry and keep your household running smoothly. No matter if the economy is booming, slowing down, or even in a recession, you keep buying these products. They're part of your daily routine, rain or shine. The companies that make these must-have items are known as consumer staples companies. They're the backbone of the products we rely on every single day. You'll recognize their brands instantly. These are the names you see every time you walk down a supermarket aisle, from cleaning supplies to breakfast cereals. Because people always need these products, companies in this sector tend to have steady, predictable sales, regardless of what's happening in the broader market. That's why investors are drawn to them. They offer a sense of stability and peace of mind, especially during uncertain times. In the investing world, these are called defensive stocks. They act as a shield, helping to protect your portfolio when the market takes a hit. While luxury brands and non-essential products may see sales drop during tough times, consumer staples keep flying off the shelves. People might cut back on vacations or fancy gadgets, but they won't stop buying soap or cereal. This reliable demand acts as a cushion for your investments, helping to smooth out the bumps when markets get rocky. So, when you hear the term consumer staples, think of strength, reliability, and the kind of steady performance that can anchor your portfolio. They may not be the flashiest stocks out there, but they're the workhorses, quietly powering your portfolio and providing balance alongside more volatile investments. Over time, investing in consumer staples can help you build wealth steadily, thanks to their consistent performance and resilience. That's why, when a major firm like Morgan Stanley highlights a consumer staples stock, it's a signal worth paying attention to. In the next section, we'll explore what makes these stocks so attractive and why they might deserve a place in your portfolio. Now let's dive into the news and break down what's happening in the world of finance today. Every day, analysts and investment banks release new reports that can move markets and shape investor sentiment. But what do these ratings really mean, and why should you care? Let's unpack one of the most important signals you'll see in the financial world. Today, Morgan Stanley, one of the world's most influential investment banks, has just initiated coverage on a specific consumer staples company. This isn't just a routine update. When a major player like Morgan Stanley starts following a stock, it's a sign that something significant is happening. Their team of expert analysts has spent weeks, sometimes even months, poring over financial statements, meeting with company management, and analyzing industry trends. They've done a deep dive into the company's business model, competitive landscape, and future prospects, and now they're ready to share their findings with the world. The result? They've given the stock an overweight rating, a term you'll see often, but one that's sometimes misunderstood by everyday investors. So, what does overweight actually mean? In simple terms, it's a recommendation that this stock should make up a larger portion of your investment portfolio compared to other stocks in the same sector. It's a way of saying, we believe this company has more upside potential than its peers. This isn't just a casual suggestion. It's a strong signal of confidence from a team of professionals who have done their homework and are willing to stand by their analysis. These experts are staking their reputations on this call, and that's not something they do lightly. An overweight rating means the analysts expect this stock to outperform its peers over the next 6 to 12 months. In other words, they believe it will deliver better returns than other companies in the same industry, making it a potentially attractive opportunity for investors looking for growth. Remember, this isn't a casual endorsement. These analysts are putting their reputations and their firm's credibility on the line. They've considered the risks, weighed the opportunities, and concluded that this stock stands out from the crowd. When you see a big bank like Morgan Stanley give a stock an overweight rating, it's a green light to take a closer look. It doesn't guarantee success, but it does mean the stock has passed a rigorous screening process. Of course, that doesn't mean you should buy blindly. Every investor's situation is unique, and it's always important to do your own research, consider your risk tolerance, and think about how this stock fits into your overall strategy. But when Wall Street's top minds see real potential, it's worth paying attention. These ratings can be a valuable starting point for your own analysis and can help you spot opportunities you might have otherwise missed. This isn't just any company. It's one that's caught the attention of some of the most respected analysts in the business. That kind of recognition doesn't come easily, and it's often a sign that something special is happening behind the scenes. Spotting these signals is the first step in uncovering a great investment. By understanding what an overweight rating means, you can make more informed decisions and potentially get ahead of the curve. So, let's see what else the analysts are saying about this company and dig even deeper into what makes it stand out in today's market. Along with the overweight rating, Morgan Stanley set a price target, $105 per share. This means that, after careful analysis, their team believes the stock could reach $105 within the next 12 months. Price targets like this are a key part of how analysts communicate their expectations to investors, and they're based on a blend of data, forecasts, and professional judgment. But what exactly is a price target? It's an analyst's best estimate of where a stock's price could be in the next year or so, based on their research and outlook. It's not just a random guess, it's a carefully calculated figure that takes into account a wide range of factors, from the company's financial health to broader market trends. For example, if the stock is trading at $85 right now, a $105 price target suggests a $20 potential upside. That's nearly a 24% increase, which can be significant for investors looking for growth opportunities. This potential gain is what often draws attention to stocks with higher price targets. These targets aren't set lightly. They're the result of deep research. Analysts dig into sales numbers, profit margins, and industry trends. They look at how the company stacks up against competitors, and they consider economic factors that could impact future performance. While a price target is never a guarantee, it's a sign of optimism from experts who have spent hours poring over the numbers. It signals that, based on what they know, there's real potential for the stock to climb. To arrive at this number, analysts use complex financial models and company data. They forecast future earnings, estimate growth rates, and factor in risks. These models help them translate all that information into a single actionable price target. When the price target is higher than the current price, it means analysts see the stock as undervalued. In other words, they believe the market hasn't fully recognized the company's potential yet. For investors, a price target serves as a guidepost, a reason to take a closer look at the stock. It can help them decide whether to buy, hold, or sell, and it often sparks further research and discussion. Ultimately, a price target reflects expert confidence in the company's future. It's a public statement that, based on all available information, the outlook is positive. So don't just look at the number, see it as a vote of confidence from professionals who've done their homework. It's a signal that the company could be headed for better days. That's why this $105 price target matters. It's more than just a number, it's a carefully considered forecast, and a reason for investors to pay attention. One big reason for Morgan Stanley's optimism is brand equity, the power of a trusted name. Think of brands you buy without hesitation, like Band-Aid or Kleenex. This company has that kind of brand power. People know and trust it, giving the company a huge edge over competitors. Loyal customers stick with what works, even if prices rise a bit. This loyalty means steady sales and reliable profits. Strong brands also give companies leverage with retailers. They can command better prices and shelf space. Brand equity isn't just about recognition, it's a real financial asset. It helps maintain market share and profitability. Morgan Stanley sees this brand strength as a key driver of long-term growth. It's a major reason they're bullish on the stock. 12. Another reason for excitement? Organic growth. That means the company is growing by selling more of its own products, not by buying other companies. It's like a plant growing taller on its own. This can happen through better marketing, new products, or expanding into new markets. For example, launching a new coffee flavor or selling in a new country. Organic growth shows the company's core business is strong. Morgan Stanley believes this company is great at innovating and expanding. That's a sign of a healthy, well-managed business. For investors, strong organic growth means the company can succeed on its own. 10. Let's talk about margin expansion, making more profit from every sale. Margin expansion means the company is getting more efficient or selling more high-margin products. They might cut costs, improve production, or encourage customers to buy premium versions. Every dollar saved or earned from higher-priced products boosts profits. Morgan Stanley thinks this company can both grow sales and improve margins. That's a powerful combination for investors. When profits grow faster than sales, the stock price can rise quickly. This is a core reason for Morgan Stanley's bullish outlook. Margin expansion is a sign of smart management and a strong business. 10. Here's where it gets interesting: pricing power. This company can raise prices without losing customers, thanks to its strong brand. Most companies fear raising prices, but not this one. Loyal customers stick with their favorite brands, even if prices go up a bit. This lets the company offset rising costs and protect profits. Morgan Stanley believes the market hasn't fully recognized this pricing power. As the company raises prices and maintains sales, profits should climb. That's a key reason for the $105 price target. Pricing power is a rare and valuable asset. It's a big part of why this stock stands out. 11. So why is this stock undervalued? Sometimes the market gets too focused on short-term worries or lumps all consumer stocks together. Investors may overlook steady, reliable companies in favor of flashier trends. Morgan Stanley's analysts look past the noise and focus on long-term fundamentals. They see strong growth, expanding margins, and untapped pricing power. The market hasn't caught on yet, creating an opportunity. Their overweight rating and $105 target reflect their conviction. They believe the stock will rise as the story unfolds. 9. So, what does this mean for you? Morgan Stanley sees a stable, essential company with a trusted brand and strong pricing power. They predict organic growth and expanding margins, a recipe for rising profits and stock price. The market may be underestimating this potential, creating a window for savvy investors. It's not about chasing trends, but about steady, long-term growth. As always, do your own research. But when experts lay out such a clear case, it's worth a closer look. 8.